My guest today is Alan Ellman. He's an expert on covered call writing. We're going to talk to him today about some of the mistakes that traders make with this strategy. So Alan, there's mistakes that you can make in all kinds of different tradings. What are some big ones in covered call writing?
Tim, I've made them all, but I've learned from my mistakes. I would say probably the biggest mistake that most covered call writers make is they sell only the out-of-the-money strike price. As an example, you buy a stock for $48, you sell the $50 call. That $50 is above the current market value of the stock, therefore out of the money. Now the reason that strike price is so impressive is because you can generate an initial return on the option and also generate additional cash on the sale of the stock. So most covered call writers will gear in just to that one particular strike price. However, there are certain situations and scenarios where the in-the-money strike makes the most sense. Those scenarios are when the market is bearish or volatile, or if the chart technicals of that particular equity is mixed rather than all bullish. So if you sell an in-the-money strike, and I'll give you an example of that too, you buy a stock for $56 and you sell the $50 call. Now intuitively for beginners it may seem, why the heck would you do that? But the premium that you'll receive for selling that option will compensate you for that $6 difference and a little bit more. And it's that little bit more that's your actual profit. And that $6 difference will give you protection of that profit.
Do you risk getting called away though on your stock if you do it too far into the money before even expiration?
Yes, there is a possibility of getting your stock called out. Now, for me that's no big deal. If your stock gets called out, assuming no tax consequences and you're not into dividend collecting, then you've maximized your return for that particular month and you take the cash and you move into another position. However, early assignment usually never takes place unless there is a dividend distribution. So the shares will be sold the day after expiration Friday. You can always prevent that from happening by rolling the option, and that means buying back the near month and then selling the next month's option. So if you don't want your shares to be sold, you can avoid it.
All right, so I should be aware of when stocks are paying dividends before I get into that strategy.
You should be aware of the ex-dividend dates because your shares will be sold early, normally the day prior to the ex-dividend date. So if you want to hold on to your stock and the dividend is important to you, then you should roll that option the day prior to the day before the ex-dividend date. However, if you're using a covered call writing strategy, the dividend is really not the key part of that strategy. So I tell all my members of the Blue Collar Investor to focus in like a laser on the strategy you're using so you can make the best informed investment decisions.
Alan, thanks for your time.
Pleasure.
You're watching the MoneyShow.com video network.